And this week we're going over a stock in the retail building supplies, and that's Watsco, and I bet you never heard of it. Stock symbol WSO, but guess what, folks? This stock is up over 40% year to date, so it's doing very, very well. Building supply company. And remember, if you want to live on this beach like Jimmy Buffett did, you've got to invest even better than Warren Buffett does now. So let's go to Watsco. What does it do? Very simply, folks, it is the distributor of heating, ventilation, and air conditioning equipment, as well as the related parts and supplies that go along with that HVAC. Now you know what HVAC means, heating, ventilation, and air conditioning. And it works in the United States and overseas, has over 7,000 employees, so it's a pretty good-sized company. And when we look at the various statistics of Watsco, these are the green vertical lines, and we're comparing it to the average stock in the S&P 500, which are the blue lines. So when we look at the return on equity, which is a measure of efficiency as well as income, we're looking at almost tripling the average stock in the S&P 500, so 33.8% for the clean surplus return on equity. When we come to net income, again, Watsco is outperforming the average stock in the S&P 500 by about 50%. So we're looking at a nice net income growth rate in here. When we look at revenue 9.8% versus the average stock of about 7.1%. So Watsco is outperforming in all areas. Now let's look at some of the numbers, and what we look at, this is the clean surplus return on equity, and don't let the numbers make you dizzy, but what we look at is the 10-year average, 5-year average of the ROE, and the 3-year average. And we can see that over the years, this company is becoming more and more efficient. It's making more and more of a profit on the items that it sells. Now, the retention rate is the amount of money the company puts back into itself in order to grow, and the rest of it goes for the dividend, which is just almost 3% as of this morning when I started putting this video together here. Now, one thing I want to point out, years to pay debt, it would only take a couple of months. If it took all the money it's making and uses it just to pay off debt, it would take just a couple of months to pay off that debt. So when we think about rising interest rates, we don't want to see a lot of debt in a company, because that means the interest on the debt goes up and it takes more money to pay off the debt rather than going back into itself in order to grow or give it back to the shareholders in the form of this 2.9%, 3% dividend. Now, one thing we like to see to get in our growth portfolio is a higher retention rate, because the more money it puts back into itself, the faster it grows. But in this case, it's putting a lot of the money back into the dividend, and we see the dividend growth on the 5-year average at 10%. What does this mean? This means that maybe Watsco doesn't quite qualify for our growth portfolio, but it sure does qualify for our dividend growth and income portfolio, because the dividend growth and income portfolio, we want to see a stock that has a dividend that's growing 7 to 8% a year and a price that's growing 7 to 8% per year. So we look at the equity appreciation along with the dividend growth rate. So what is that price appreciation? And this is what we look at, folks. With the black line, the S&P 500 up about 14%. We are looking at Watsco up almost 30%. So it's growing this year. For the past 12 months, it's growing double that of the S&P 500. So this is measuring for 12 months. Black line, the S&P 500. Watsco is this yellowish colored line. So growing twice as fast as the average stock this year or the past 12 months. Now, when we look at 5 years, we look back in here, it was underperforming the S&P 500. Then when the market went down during COVID, this stock actually went down about half as much as the market, because I guess everybody still needed heating and air conditioning, so this company was right there with new equipment. So this was a surprise to us as being a fairly defensive stock, even though the building supply area it can be cyclical at times, but this stock is fighting against that because it only went down half as much as the S&P. And since COVID, this stock has been growing faster than the S&P, and then in 2022 it went down less than the S&P, and then all of a sudden took off like a rocket to be doubling the S&P, almost doubling the S&P over the past 5 years. So it's doing very, very well lately, and we kind of like this stock. But now here's what I want to show you. This is just the price of Watsco. So it's nothing else, past 5 years. So this is 2023, 2022, 2021, and this is 2020. So look what it did during 2020. And let's say the average price is right around $210 up to $240 by toward the end of the year. So when we want to see what a company was making back when it reached this price in here, even if we take the average price during the year, about $210, and what it's going to make this year or next year. So let's look at that. Well, back in 2020, it was making $7.01 per share. For next year, 2024, it's going to make, or it's projected to make more than twice as much. So if we go back to the stock price, here was making $7 a share. Now it's making more than double that. So really, we could be looking at this $2.10 to $2.40 of being double, because it's making more than double the money it did when it was this price back in here. So we're looking at a stock that could be $420 to $480 by the end of next year. That's why we like Watsco, because the dividend is growing, the company is growing, and we're in a building supply shortage, or we're in a housing shortage, and so the building supply companies will do very well indeed. So yeah, we're looking at this stock to continue to go up as long as the economy is growing, and we think it's going to be growing nicely in 2024. So yes, we like this stock, and we like the stock especially for our dividend growth and income portfolio.